Hello learners, students, welcome to my channel. This is my second video. So we are continuing our topic. So as a part of research analyst certification course for the exam preparation, uh, we will continue for the chapter 2. So this chapter 2 name is an introduction to securities market. If you see, this chapter has some weightage. Uh, so it has like more concepts. It may take some time. I will explain in detail to the important topics and I'll skip the non-important ones. So we consider with the exam point of view. I'm considering what topics what topics they'll ask in an NISM exam. Okay, we'll stick to that and we'll move forward. Okay. Um, not waste much time. Let's start. uh, let's see, like 2.1, introduction to securities and securities market. So like guys, what do you mean by securities? So these are like transferable financial instruments that show evidence of ownership interest in assets incorporated by entity. Like it's just a securities are nothing but it's a ownership of a particular proportion of a company. Okay. So the efficacy of securities allowing movement of capital is achieved through an efficient securities market that allows investors and sellers to buy and sell securities. Securities market brings together a large number of buyers and sellers and thus creates liquidity. So simply security market where people buyers and sellers come together to sell and buy shares of a different companies, right? This is what is stating. You can see here a short image of securities market. Okay, I'll how the funds flow from one end to one other end, like direct finance and indirect finance. You can see this image and understand what it is able to tell. So if you have surplus income, like who have surplus income, households, business firms, governments, farmers. So they'll invest in this direct income units like business firms, government, household. So through the intermediary, through financial mediatories. So the surplus ones goes to these funds and get the return or capital appreciation and back. And so let's see what does the term securities include. Shares, scripts, stocks, bonds, debenture stock, and other marketable securities are like nature in or on. So the in securities, there are a lot of terms it included. As I told you earlier, shares, stocks, bonds, and derivatives, units of an instrument. So, like if this stating that about mutual funds. So if you invest in a mutual fund, you'll get a units instead of shares. If you're holding one unit, so you will investing in different many companies, a proportion of many companies. If you invest in one unit, if you get a one unit, so how they divide, we'll talk about that later. Let's see product definitions or terminologies. Like what do you mean by equity shares? Equity shares are the uh, it's a fractional ownership of a business of a company simply. So the collective group of equity shareholders combined equity shares together can own a company. So here equity shares issued by companies. So the investors are like general retailers like us, HNIs, high net worth individuals, or foreign institutional investors, FIIs, DIIs, domestic institutional investors like mutual fund affiliates or some financial firms, etc. FPIs like foreign public investors. So the medium is the they can directly issue or they can use the stock exchange as a medium to issue the shares. The regulatories are you all know that SEBI are the regulatory of the securities. The second one is debentures, bonds, notes. So debentures issued by companies, government, special purpose vehicles, etc. So the debentures means it's a debt instruments to raise a loan. These are unsecured, maybe unsecured or secured in nature. So this debentures has three components like convertible, non-convertible, partial convertible. The name tells the definition. Convertible, the debentures which are convertible into shares. Pa- Partial convertible debentures are like tells that the debentures converts partially into ordinary shares in the later part. Non-NCDs, non-convertible debentures means like they'll get a fixed interest with a principal back. They'll not convert into securities. This is what NCDs are known as. So let's see about foreign currency bonds. Foreign currency bonds issued by a company in a currency that is different from the currency of its home country. You got it. For example, to construct a Delhi International Airport, an SPV like special purpose vehicle of GMR Infrastructure Limited issued USD bonds. This could also have a feature of conversion into shares if needed based on the preferences of issuers investors. These are issued by companies, government, SPVs. The investors are like institutional individuals. They can issue directly or via stock exchange. Regulatory in the respective country of issue. See, companies in emerging markets may prefer to issue bonds in USD or currencies of other economically mature countries or carries foreign versions. Mhm. So these bonds has a risk of like foreign currency risk. So you know that currency rates will fluctuates, the value of rupee shares depreciates based upon the economy depends. So coming to the next terminology, it's external bonds. What are external bonds or masala bonds? So external bonds also referred as euro bonds are the bonds. These bonds issued in a currency like in it different from the currency of the country which is issued. For example, if the company issues US dollar denominated bonds in Kuwait, it would be referred as euro bond. as the currency of a bond USD is different from the currency of where it is issued. So, for suppose external bonds denominated in Indian rupees are referred as masala bonds. These bonds issued outside India. So, if you see in 2014, masala bonds were issued for the first time in London Stock Exchange. So, it's very simple. Bonds issued in a currency that is different from the currency where it is issued. From a different, simply it's different from home country. They no, no, no. They bonds in Kuwait, external bonds denominated in Indian rupee, as referred as masala. Yeah, I already told you. And the next one is warrants and convertible warrants. Warrants are options that entitle an investor to buy equity shares of the issuer company after a specific time period at a predetermined price. Only few companies have issued these warrants. It's a simple, like looks like forwards. It's like it's a non-existent. Just don't remember indexes. So this is very important, guys. So market index means it tracks the movement of it tracks the market movement by using the prices of specific number of shares chosen as a representative example. So simply index, if you see in our India, we have like major indexes like Sensex Nifty. So for suppose Sensex tracks the top 30 firms, Nifty tracks the top 50 firms, like diversified funds like for companies. So we can judge by seeing the indexes whether how is the Indian economy, like how is the Indian market, how is the market, is it doing well or not? If the points were increasing, we are doing good, or else vice versa. So if you see, every country has their own indexes. India has Nifty and Sensex. US has National Stock Exchange, Dow Jones. So this is what index means. And so you can see some of the common indexes listed here: mid cap, small cap, BSC 100, Nifty 500. These all are indexes. This gives a returns comparison of returns on investments in stock markets as opposed to asset classes such as gold or debt. We can compare with this. You see, the gold and the Nifty index are some mostly like vice versa. No, no, not vice versa. But, you can compare with the returns with the other asset classes like gold. That is what main. Why I told vice versa is that if suddenly some impacts happen, some macroeconomic effect like war, inflation, of like foreign investors taking out of money, like going out of the country, selling their shares of Indian companies. That kind of situations you see like the gold price moves higher. compared to this. Next, mutual fund units. So mutual fund units are investment vehicles that pool together the money contributed by investors, which fund invest in portfolio of securities that reflects the common investment object of the investor. Each investor share is represented by the units issued by. It's like pool of vehicle. Simply, if you are feared of investing in securities, you can consider mutual funds. Like these are like indirectly you are investing into the shares. There is a fund manager who manages this fund. He collects the money from the retail people from us and invests. He collect he collects money. The collective amount will be invested in different shares. So he actively manages, and so in return we'll get a units. So slowly our capital appreciates if the market performing well and mutual fund will also perform well. So if you it's like there is a you can you will get a unit. So the value of units may be like net asset value because now. So you can see if the nav is growing, so we are performing better. If it is not growing well, it is not performing well. This is you can interpret from this. So there are like open-ended, closed-ended mutual funds. Open-ended are like it is open anytime. Anytime you can buy anytime you can sell. There is no restrictions for this. The closed-ended is like the funds are like they'll raise funds in a particular time period. If they raise funds, they'll close. They'll not allow us to sell or buy again. So they'll manage the funds. There will be lock-in period. After that lock-in period, we can withdraw that. That is what we're closing. We'll learn much about later. We are running out of time. So ETFs are like it's a replicate of stock market. So it is also an investment vehicle. Pools money from investment, not pools money. Uh, Funds pooled by the investor to track the index. So if you invest in a ETF, you are investing into the particular sector or fund. It is like passively managed. It's just a replica of index or benchmarks. Simply you can say. You can consider that also. So the expense ratio will be there. And the next comes to preference shares. Preference shares. So here you can understand the preference given to the particular shareholder or investor. So preference shares. So the companies directly give preference to some particular entities or persons and allot shares to them. So while the main benefit of preference shares is while company winding up, so they will get first. They will be paid first, then the ordinary shareholders. So preference shares will get the priority compared to ordinary shares in terms of distribution while the company wind ups. Uh, so one the disadvantage of preference share is they don't not have hold voting rights. So equity shareholders like ordinary shareholders hold the voting rights. They can vote on some particular decisions of the company, which preference shareholders will not. So their dividend is carried forward. So next, let's see term debentures. Debentures I already told you, like right. This three I already told you. I already told you like the debentures so means it's like that instrument you will get a you can invest into the company in the form of debenture. Like it's a loan, it's a kind of loan you are giving to the company. The company will give uh, returns. I mean interest rate in, with all it as a coupon rate as well. So you will get a coupon rate for certain years, with, and you will get a final at the time of maturity. You will get your invested money like principal. Simple terms. Let's talk about IDR, GDR, and ADR. These are very important. These three. Any one or two might maybe asked in the exam. The question in the question paper you can see at least one or two questions from this IDR, ADR, GDR things. So like simple guys is depository receipts are financial instruments that represent shares of foreign company. Understood? These depository receipts trade in the local market and are denominated in local currency. Got it? If you want to buy, let's simple terms. If you want to buy shares of foreign country, you cannot buy directly. Now you can buy directly, but generally earlier you can buy via this depository receipts. Let's see the process of depository receipts. So a company or an investor delivers, for suppose company or investor delivers their shares to the bank, their share equity shares to the bank. So the bank what will do? The bank places that shares in the custodian account. Okay, where the country is located. Then the bank issues the certificates like depository receipts to the investors in the overseas market. So if the issuing company is the one that delivers securities and initiates the money, is referred as a sponsored depository receipts. Then they can be listed in exchanges of country. So if the shares are delivered by investors, they are referred as unsponsored depository receipts. Typically, unsponsored DRs are not allowed to be traded in stock exchange. They are traded over the counters. It's like offline thing. We'll get in later. So here you can understand. I'll tell. If you want to invest in an Apple company, you can invest via Apple's GDR, uh, ADR, American Depository Receipts. So let's see what is ADR, IDR, HDR, GDR. ADR are issued and traded in USA that are issued by non-US companies. ADR is issued by non-US companies. Some of the Indian companies like Infosys, Wipro, ICICI, these companies are issued ADR. So like simply they raise funds of many of they raise funds by issuing these areas. So many of the American citizens they can invest in Indian market via this area. You understood, right? Yeah. Next idea. Indian depository receipts are issued and traded in Indian market. These are issued by it's similarly like area, non-Indian companies. So those companies who want to raise funds from India, they can issue IDR. Hong Kong depository is similar to the above. I cannot repeat. I don't repeat. Like GDR is like it's a global depository ships. The name it tells like GDRs are issued in Union, European Union member states. So this is a GDR. Next, let's go FCCBs. This is also very important. Foreign currency convertible bonds. These are these bonds are foreign currency denominated convertible debt bonds issued by companies in international markets. These instruments are to be understood the way convertibles are with only difference they are generally optionally allowed. Issued offshore in different transactions of guidelines and RPA. So the payments of the interest and repayment of the principal of the bonds in the foreign currency. So next, equity linked debentures. So these are like floating rate debt instruments. So there you will not get a fixed interest uh, as a return. So here you can see like equity linked debentures. So your proportion of capital is invested in debt instruments like some securities like bonds to protect some principal. So the excess returns will be invested in some derivative products like options, option buying, etc. So here you will have some risk like credit risk, there will be like default chance. So it is some kind of a risky instrument. Next we'll see commodity linked debenture. Similarly, uh, similar to the equity linked debentures. So in place of derivatives of shares, they will invest in the derivative components of commodities like gold, wheat, silver, etc. This MBS and ABS, mortgage backed securities and asset backed securities. So if you know the concept of securitization, you will be knowing this. So these are like debt instruments, like issued by some banks, some financial institutions. So it is a combination of some home loans, rent receivables, credit card receivables, etc. So in simple terms, for a bank give lends money to different purposes for home, for credit, for rent, home, credit card loan, for personal use, etc. So the combined of home loans from different peoples. So the you will get interest and principal directly from the borrowers, where bank act as the immediate. Next, REITs. So real estate investment fund. REITs are like investment vehicles. So the pools similar to mutual funds, they pools money from different people, various investors, and invest in the real estate projects or infrastructure projects. So regular income infrastructure projects. So in case of REITs, 80% of assets should be held in the form of real estate. Similarly, for InvITs, regulation stipulates that 90% of the unit capital should be invested in revenue generating infrastructure projects. These assets can be held directly or through special purpose vehicles. In the case of both REITs and InvITs, the trust has distributed 90% of distributed surplus as well the unit holders. Commodities, these are the basic materials that are largely homogeneous in nature. So these commodities are like soft commodities, hard commodities. Hard commodities are especially natural resources like it may be mined or extracted, like metals, crude oil. Soft commodities are like examples of that, like agricultural products, grains, pulses, etc. These prices of commodities depends precious metals. There is an option other of like gold and silver. You can invest in gold and silver as well as an option. Commodity ETFs is similar. As I told you, ETF is a replica of index. They're passively managed. So it's commodity is also a replica of the commodity funds. These are reflect the price of commodities like wheat. It depends on the like wheat, gold, gold ETFs. It is if the gold prices moves, the gold ETFs will go up. So there will be no much difference in these ETFs. So it's like if you can invest in a gold virtually by ETFs. Simple. Managed future contracts refers to the portfolio of future contracts that are actively managed by professionals. We are professionals will manage, right? So warehouse receipt, what does it mean? It's a document that shows proof of ownership of goods that are stored in warehouse. These are negotiable. Underlying goods can be transferred by simply transferring the receipts. Structure of securities market. So securities are issued. Securities market has two things: primary and secondary market. Simply, I'm telling. So primary market is known as new issue market. When a company want to raise funds for the first time, or they want to list in the stock exchange for the first time, they can they can be called as the primary market. Secondary markets. So these are the already listed securities. So those who want to exit and buy new shares of the listed, they can participate in this. So let's see the instruments of primary market. There is a public issue. Securities are issued in public. So anyone eligible to invest participate in the issue. It is like similarly initial public offer. Public issue is like just a term. We don't use much of this. Let's see what is it. What is the initial public offering? Whenever the company wants to list stock exchange, when they want to raise money for the first time from public, they'll come through the IPO. Yeah. Next, FPO. FPO is like follow on public offer. Already listed companies want to raise capital again from the general public, or they want to dilute their percentage of shares. They want to sell their shares, want to add new shares. So they can come up with a FPO, and this is for like second time, third time. They can come to this private placement. So this refers companies issues large quantity of shares to a set of investors by their choice. Under a private placement, it should not exceed 50 people. These private placements may be QIBs or QIBs or professional. Let's see what is qualified institutional placements. These QIP is a private placement of shares made by listed company to certain identified categories of investors, known as QIPs. This includes banks, mutual funds, financial institutions, etc. Next, let's see what is preferential issue. So, issued preference issue means the issue of specified securities by listed issuer to any select person or group or on private placement. It is similar to private placement issued to the only some specified people, some specific people. Listed. These might be like components of preferential issue might be like rights issue, bonus issue, employee stock option, employee stock purchase scheme, etc. The rights issues are means companies want to issue funds from their shareholders, so they can issue the rights issue. They can raise funds via rights issue. Here, shareholders has a right to buy the additional shares, but not obligation. If they don't want to buy, they can pass that right to the another by another shareholder, or they can sell that right to the another person. Mm, bonus issue. They here the company can decide to give additional shares to specific to the shareholders. Onshore and offshore offerings are like simple. If a capital raised from domestic market, it is a onshore. If a capital raised from foreign market, it's offshore. Estimated. OFS I already like offer for sale. If the existing shareholder wants to sell his shares, he can come with the OFS. He can sell via OFS. Sweat equity. Sweat equity. It is the company may issue shares to its employees, promoters, technocrats, other as a reward for their contribution to the company. So sweat equity given to the some particular people who contribute in the success of company. It helps reduce the agency risk. After raise capital, transaction doesn't run new shares. Just a reward to them for their for their contribution. They keeping the sweat and blood to for the company's growth. Next, employee short of then ESOPs are like they have an option. ESOPs are like instruments given by company to its employees. They give them option to buy the shares of company at predetermined price at a discount. That is the second side in the security market, so and they get bulk amount. There is some vesting period, so the employees making contributions like we stay with us for 3 years, then this ESOPs will add it to you. And securities market is a secondary market, so it has more liquidity to liquidate the primary issue. Secondary market should be issued. Many of the buyers and sellers come together in the secondary market and participate to buy and share shares. So here OTC over the counter markets are like trade directly between the two parties. Trade with two or more counterparties. Here it is like a physical one. So it's a directly you can trade. There will be no stock exchange or mediator here. Exchange traded markets. These are the other option of trading and securities through the stock exchange route. Yeah, there is a clearing corporation, etc. etc. Trading is a formal conduct to buy or sell or execute the trade. Clearing and settlement. Clearing and settlement are the post-trading activities. Clearing activity tells that all about the net obligations of buyers and sellers for specific period. Settlement is the next step of settling obligations by delivering shares or paying money back to them to the buyer. Etc. While OTC transactions are settled directly between counterparties. The clearinghouse gives an obligation report to brokers and custodians who require settle their money or securities obligations. Risk management. In OTC transaction, counterparties are expected to take care of credit risk after in exchange traded gold, the clearing corporation requires due settlement guarantee. These expose the clearing corporation to take the risk. Market intermediaries, you can read this. There are stock exchange depositories. Depositories, CDS, and still the major to market depositories. So if you buy any shares, the broker will not hold the depositories will be holding these trading numbers. You know who are all trading numbers, sole proprietors, retailers, partnership firms, etc. Authorized person is any person, individual appointed a stockbroker or a trading member as an agent to reach out to the investors scattered across the country. Custodian is an entity that is charged with the responsibility of holding funds and securities of its large clients. As banks, form portfolio, this is transaction securities. Clearing corporation play an important role in safeguarding the interest of investors in securities market. Clearing agencies ensure that members on the stock exchange meet their obligation to deliver funds or security. The agencies act as a legal counterparty to all trades and guarantee settlement of all transactions on the stock. It can be a part of exchange or separate. Clearing banks act as an important intermediary in clearing numbers in the clearing corporation. Every clearing member needs to maintain an account with the clearing bank. It is clearing members responsible to make sure that the funds are available in the account. Merchant bankers are entities registered with SEBI, act as issue managers, investment managers, lead managers. They help an issuer to access security market with the issuance of securities. Underwriters or intermediaries in primary market who undertake to subscribe any portion of public offer. Institutional participants, FPIs who directly invest in India, foreigners who directly invest in India, each P-note participants, participatory notes are instruments issued by SEBI registered foreign portfolio investors to overseas investors who wish to invest in the Indian stock market without registering themselves with their market securities. Now, P-notes provide access to Indian securities to the investors of foreign countries. Mutual funds, a pool of securities, pool of money invested in a group of securities with the hope of to generate returns. Insurance companies mainly they aren't like selling their insurance products. The insurance are like involves life insurance, gender insurance, health insurance, etc. These companies have a huge corporate and they are one of the most important investors in Indian economy. Pension funds, a fund established to facilitate and organize the investment of the retirement funds. The pension fund is a common asset pool meant to generate stable growth over time. Venture capital funds, the first pooled investment vehicle like mutual fund but with mandate to invest money in expertise. PEs are of early stage growth for expansion buyouts. Hedge funds are like very risky. Users operative products. AFs are like develop many category one, two, three. EPFs is a scheme that is used to provide benefits to the employees. So to generate 12% of their salary is go to the employee provident fund. The fund will later invest in some debt funds and they will get it out. And this is a government sponsored retirement scheme. It is an optional. Those who want to buy these NPS they can participate in this. Other than that, family offices means family the organizations who manages the wealth of wealthy family. They'll see their accounting and day-to-day income, expenses, handling payments to vendors, household stuff, etc. Corporate treasuries are the companies or businesses having a large surplus of funds which they use for the potential opportunities in future. So they get an opportunity to invest in different type of securities. Retail participants who buy sell shares securities in personal account. Proxy advisory services firms. These proxy advisors advise investors in relation to exercise of their rights in the company, including recommendations on public offer or voting recommendations on agenda items. An investor may not be able to track shareholder announcements, all the investee companies, or analyze proposal. Service of proxy advisory add value to them. Proxy advisors analyze voting proposals and how it affects the interest of investors. Eventually suggest how to vote. Proxy advisors are typically engaged Kinds of transaction. There are different cash, tons, spot trades, transactions. Cash trades are generally T plus 0 days, constantly settlement. When it comes to financial markets, it's generally T plus 1 day. Tom trades are settlement occurs on the day next trading day. Some of the transactions in the foreign exchange spot trades are the trades where settlement occur on a spot date or normal to business days on the trade date. Forward contracts are the agreement between two parties to buy or sell underlying asset at the future date to determine the price. If it so traded over the counter, it's not. Futures are similar to forwards, but they trade in exchanges, stock exchanges. Option is a contract that buyer gives and right, but seller not obligation. So, buyer not obligation to buy or sell underlying asset on a post editors. The premium of the price array divided by seller of the option versus the premium of the obligation of selling. So this you can easily understand all two. Swaps are contract between two parties in the exchange of cash. Trading, hedging, arbitrage, pledging of shares. Trading is buying or selling of securities. Hedging is they will take opposite position of their holdings to mitigate the risk. They'll do hedge to mitigate the loss. Arbitrage is buying a small difference of shares in one company and selling it on to another company with a huge quantity. Price of shares means keeping our shares as a low as a collateral and request for the money with loan. Dematerialization is the process of converting the physical into digital, physical into electronic form with the securities. Dematerialization is the reverse of dematerialization from the electronic form to physical form, like pen paper form. According to SCRA, securities involves the following. All the above you can see. Along with the SEBI, other regulators under Companies Act RBI also regulate the equity share market. Create the true or false. Where the entire face value of a debenture is converted into equity shares, which is known as fully convertible debentures. Depository receipts which are issued in India and listed on the Indian Stock Exchange with foreign stocks as underlying is known as idea.